This is Chapter 4, Learning Objective 4, talking about W-2s. Employers are required to furnish a Form W-2 to employees. They also send copies to the federal and state local governments. So the IRS and the state government is looking to make sure that you report on your income tax return what they know you made because they got the Form W-2 from your employer. On the W-2, it reports your wages and withholding taxes. The instructions for completing the Form W-2 are in your text. The employers are to get a hard copy to their employee on or before January 31st, or they can post it on a secure website so that the employee can just access their W-2, nobody else's but their own, and they can download it. If a company is issuing 250 or more W-2s, they can't send in a big pile of paper. They have to use magnetic media, and they have until March 31st to do that. The W-3 is a transmittal form that goes with the W-2. It's kind of like a cover sheet, and it summarizes all of the wages paid and taxes withheld. And the 941s for the 4941s for the quarter have to tie to the W-3 totals, which means it has to agree with those. There's various penalties for filing incorrect or late W-2s. But if you do have to correct a W-2, then you file a W-2C, that stands for corrected. And every form that's filed always needs a transmittal letter or transmittal form, and that's what the W-3C is. The quarterly and informational returns that you have to do. For the wages, you're going to record the payroll income tax withholdings on a Form 941. We've looked at that in the previous chapter. Employees also have to file information returns for anything that they've paid independent contractors. Well, I should say anything over $600. If they haven't paid $600 to anyone, to a contractor, then they don't have to give them a 1099. The 1099 miscellaneous is the form that they send the contractor, and the 1096 is the transmittal letter that they send in. So the 1096, again, you send a copy to the contractor. Did I say 1096? I meant the 1099 copy goes to the contractor and to the federal, along with the 1096 to the federal. You have to issue a 1099 to anybody that did work for you, that you paid them at least $600 and they weren't incorporated. So if somebody comes and fixes your computer and they're just doing it on their own, they're a sole proprietor, and you pay them $800, you need to send them a 1099. I have a friend, a client who's an attorney, and she has another attorney that's doing some work for her. He's an independent contractor. We had to issue a 1099 to him because she paid him more than $600 last year. The independent contractor has to submit a Form W-9 with their taxpayer ID number on it. So on the 1099, you list the taxpayer ID number. If this isn't done, then when you issue the 1099, you also need to withhold federal income tax of 28%. That's a big incentive for you to get your independent contractors to give you a Form W-9. And if there's any non-payroll items, like you're withholding on an withholding taxes on an independent contractor, or withholding from pensions or IRAs, you report those on a Form 945. For the state income tax withheld, and any localities that have local income tax, in general, the payroll department has to file a periodic withholding return to the state. Generally it's quarterly, at least in Utah it's quarterly, to report the wages and the state tax withheld. And then there are reconciliation returns that have to be filed at the end of the year and at the end of each quarter to compare what you actually deposited to what you withheld. And it better be the same or within pennies, or you have to correct it. Filing annual statements to report the wages paid and applicable taxes withheld. So these are more quarterly. There's annual statements, and then you have to issue an information return to report payments to individuals that you didn't withhold from. Now, sometimes what happens in some states is they have workers that live in one state and work in another. And so how do you know who's supposed to pay, what state they're supposed to pay state income tax to? Most of the time when you've got states nearby each other, they'll have reciprocal agreements, the ones that are close, bordering states, between the states. But if there's no agreement, no reciprocal agreement, then you have to sort of consider the laws of both states when you're selecting one of these three methods. The full taxation method is basically you pay taxes to both states. The leftover taxation says pay the full tax to the work state, and then you pay the rest to the resident state. And what we mean by that is the resident state would figure out what the tax would be, and then whatever you paid to the work state, that tax would get subtracted from what you owed to the state the resident state, and the difference would go to the resident state. And then there's also the reciprocity, which basically depends on the agreement. It could be that you're going to pay to the resident state, could be that you're going to pay to the work state. Most states require employers to withhold tax from both non-residents and residents unless a reciprocal agreement is in place.